Forget everything you think you know about retirement planning. They're just 3 numbers you actually need to know if you want to be able to retire comfortably. Watch this video and find out what those 3 numbers are. And hint, none of them has anything to do with your current age or salary. So jumping right in, if you really want to know if you can retire and what that retirement looks like, there's 3 numbers you must have. Number 1, you need to have your expenses in retirement. Number 2, you need to understand your fixed income sources in retirement. And number 3, you need to know what your portfolio value is at retirement. In this video, I'll show you how do you determine each of them in a very simple way, and I'll show you what to do to tie it all together to see what retirement possibilities exist. So to illustrate how we can start to tie these 3 things together and show you what different combinations of different possibilities exist to create that ideal retirement, we're gonna walk through Becky Sample's retirement plan. This is a case study where Becky is 67 years old today and she's still working, but she really wants to retire. She wants to spend her time gardening, playing pickleball, spending time with friends and family. So nothing incredibly luxurious, but something that she needs time to be able to do. And when she's working 40 hours a week, it's just difficult to find that time. So let's explore a little bit about Becky's situation so we can start to help her understand what needs to happen and how much might she be able to live on in retirement. So here's Becky's investments. She has a 401k plan with $275,000 in it. She has a rollover IRA from a previous 401k plan with $387,000 in it. And she has a standard investment account with $69,000 in it. Now, Becky is currently renting, so she doesn't have any equity value in a home, but she does have these assets and she wants to know if she can retire. Now, one important thing to note before we move on is I mentioned she has this investment account of $69,000. That was originally a home purchase fund. But as we started walking through things and as Becky started exploring options, she really doesn't know exactly where she wants to live quite yet. Part of her retirement plan is to explore different parts of the country. She doesn't want to buy something where she currently is because she kind of doesn't feel like she's going to be there for a long period of time. So she wanted to understand, what does it look like if I rent throughout retirement? And instead of using this money for a down payment, I use this to help fund some of my retirement expenses. So that's the assumption going into this plan. Not saying that's going to be the thing that actually happens, but as we're exploring that, just keep this in mind. Now, another thing to note with these investments is we need to assume some growth rate going forward. There's no way of guaranteeing any type of a growth rate, but based upon how Becky was invested, based upon her comfort level with different investments, we're assuming a 6.5% growth rate on these assets. The next thing that we need to know is, what will Becky's expenses be? So as I mentioned, there's 3 things that you need to know, the most important of which is, what are your expenses going to be? Now, we walked through this exercise with Becky. This is a spreadsheet that if you want access to it, there's actually a link that you can download in the description below. We'll send you this so you can plan for your own retirement cash flow. But what we started going through is we want to know, Becky, what does it cost to rent? What do gas and electric cost? What does water cost? I'm not going to go through this line by line, but as we started going through this, you can start to see the numbers we're planning for Becky. So this is what that looked like. So as we go to this next page here with goals, you can start to see that $5,000 per month that we're planning for, it's not just an arbitrary number, it's something that we worked through with her, of working through what will the cost of your retirement look like so that we can start to plan to see if we're on track to meet that cost. So again, if you want access to that, take a look in the description and you can get that at absolutely no cost. But $5,000 per month is the expenses that we wanted to know for Becky. The second thing we wanted to know is, what will Becky's fixed income sources be in retirement? And what I mean by fixed income sources is exclude the portfolio. The portfolio is not necessarily a fixed income source. Fixed income sources are things like Social Security, things like a pension, things potentially you can include real estate like that, but real estate is not really a fixed income source because that income could potentially go away if something happened to the property. For Becky, her salary and bonus are going away, so we're not going to include that. You can see that that's happening, or that's ending at retirement, which is now in Becky's case. But what we are planning for is her Social Security. Her Social Security benefit when she retires will be $2,700 per month. So our expenses are $5,000, and by the way, that's $5,000 after taxes. Becky doesn't want $5,000 and then pay federal taxes or state taxes and spend what's left. She wants $5,000 after taxes, and we also need to adjust that for inflation. I'll show you how. Her income sources, before including her portfolio, are $2,700 per month, as we just saw right here. So let's go back to the 3 things I said we need to know. We need to know expenses in retirement. Check. We have that for Becky. She wants to spend $5,000 per month. Number 2, we need to know fixed income sources in retirement. Also check. That's going to be $2,700 per month for Becky, which is her Social Security benefit. Number 3, we need to know Becky's portfolio value, which it seems like we have. It seems like that should be a check, but not quite. We don't need to know what it currently is. What we really need to know is how much does it need to be in order to supplement the extra income that Becky needs to supplement her Social Security income. Let me walk you through what I mean by that. Here's the page where we can actually back into what Becky's portfolio needs to look like. Not what it currently is, although that's important because we need to compare what it currently is versus what it needs to look like, but this is the part where we can back into that. So year by year, what we're doing here is in this column, we're understanding what can we expect for Becky to receive in those fixed income sources. So the second thing that we need to know, well, Social Security. Here's her Social Security benefit, and here's how it's going to increase every year. So that's one thing we need to know. The other is expenses, not just expenses of the $5,000 per month, but the $5,000 per month adjusted for inflation after taxes over time. Then in this column, we have the expenses. So as we mentioned, that's the first thing that we need to know. And it's not really just expenses today, it's expenses today after taxes and then also adjusted for inflation over time. So if we really drill into this, you'll start to see that it's not just the $5,000 per month that we talked about. It's $5,000 per month, which is Becky's basic living expenses, which if we go back here, you can see what that's going to look like. So here those are for Becky. One thing I'm going to point out though, is we didn't include health insurance for Becky because this is her current budget. In retirement, we need to add on an additional amount for what her Medicare is going to be. Now, Becky's already over Medicare age. If you're not quite Medicare age, and this might look a little different for you, but for Becky, here's what we're planning for in terms of her Part B and premium and Part D premium for Medicare, and then her additional out-of-pocket cost that we're planning for. So as we go back to her expenses, here's the $5,000 per month, here's extra healthcare, and then here's taxes that we're going to assume that she'll need to pay. Federal taxes and state taxes in order to net the $5,000 per month after all that's been paid. So here are Becky's true expenses, and you can start to see how the software is actually really helpful to calculate some of this. When we have different inflation adjustments or we need to calculate the tax impact, what this can do is help us to get a real picture of what do we actually need expenses to be if she wants to end up with $5,000 per month. Well, she needs closer to $77,000, $78,000, as you can see right here. So here's how we now back into the retirement portfolio needed. If Becky's expenses can be seen in this column, and Becky's income can be seen in this column, here is what her portfolio needs to be able to generate. Her portfolio in this first year needs to be able to generate $45,000 per year, and then it needs to increase from there. Here's the problem for Becky, is if we start to understand what does that represent as a withdrawal rate, we can see that Becky too quickly is withdrawing too high of a percentage from her portfolio. Her initial withdrawal rate, so the amount she needs to take from her portfolio to supplement Social Security and generate everything she needs to pay taxes, pay health insurance, and live on $5,000 per month after that, she's taking close to 6% out of her portfolio those initial years, and that just continues to increase. As that continues to increase, you see she gets to the point where she's actually projected to run out of money. What does that tell us? It tells us the money that Becky currently has in her portfolio is not likely to be sufficient to meet her needs throughout retirement. What do we need to do? We need to manipulate one of those three numbers. And by manipulate, I don't mean just change the number in the software. I mean, Becky, what are the planning points that you can implement in order to make your plan work? How do we increase your income, make a change to expenses, or make a change to your portfolio value so that you're not projected to run out of money? Because as it stands right now, this is what your portfolio is projected to look like. You'll meet your needs for the first several years, but you're probably going to run out of money. And this is not an acceptable outcome, especially considering Becky doesn't have any home equity value that she could ultimately fall back on. So as we start to look at this, we say, Becky, what options do you have? Well, one option is she can work one more year. Now we look at that and say, James, where does that fit into the three numbers that you said we need? We need to know our expenses in retirement, our fixed income, and our portfolio. Never anywhere did you say we need to understand what age are we going to retire by. No, but keep this in mind. If Becky works one more year, that flows into those three things. It doesn't change her expenses in retirement, but what it does do is it increases her income, because now what we can do is this. Instead of Becky collecting at age 67, she can collect at age 68. That's one more year of delayed retirement credits, so Becky's Social Security benefit is going to increase by 8% in doing this. So as we do this, one more year, really what that translates to is a higher income, and it also translates to a higher portfolio value. Now we're making assumptions, of course, that the portfolio is going to grow over the next year, and that is by no means a guarantee, can never be certain. But if Becky's saving to her portfolio a little bit more, and on average, we can at least project the portfolio going up, not guaranteeing it, but at least illustrating to Becky what might happen. we can start to see how does this impact her ability to retire. You can say, Becky, 1 more year of work, what that does is it increases the likelihood of this actually working. If we want to run a Monte Carlo analysis to actually quantify some of this, her probability of success went from 21% up to 42%. Still not quite where I'd want it to be for a number of reasons, but what you can see is that 1 extra year, the impact of that is it increased her fixed income and it increased her portfolio, which in turn increased her odds of success, but still not quite to where we'd want them to be. So I said, Becky, what if we work 2 more years? What might that do? Well, now what that's doing is it's 2 more years of her income increasing, because 2 years of delayed retirement credits, and 2 more years of her portfolio growing. So it's accomplishing both of those things. Now we can start to look at this and say there's greater chance of you having success here. We've tripled your odds of success in this scenario. Now, by the way, I get a lot of emails from people saying, hey, can we just have access to this software? Yeah, you can. There's a Retirement Planning Academy that you see here in the notes there. And part of the Retirement Planning Academy is access to this software that I have here where you can run these projections on your own. So this is what we're looking at for Becky. Now, she may look at this and say, I get it. 2 more years of work and I can do what I want to do, but I don't want to wait 2 more years. I want to start playing more pickleball. I want to start spending more time with friends and family while I still have my health, my energy, the will to do so. What other options are there? Well, we can start looking at other options. Maybe she's not working longer, but if we go back to the 3 numbers that we need to know, we can't magically just increase Becky's portfolio by just wishing it into existence. We can't magically increase her income, her Social Security, without telling her she needs to work longer for those delayed retirement credits. What we could do today is say, Becky, are you willing to cut your expenses? So the first number in the 3 numbers you need to know to retire. If we do that, we would say, Becky, what happens if you don't spend $5,000 per month in retirement, but you spend $4,500 per month in retirement? You're retiring today, still at 67. We're not asking you to work any longer, but in doing this, that alone adds more to your plan and it increases the odds of success. Still not quite to where we'd want to be, but we said this, Becky, what if you wanted to decrease your expenses to $4,500 per month? We went through an exercise to say, where would you be willing to take some of the expenses from? And so we had that conversation. And then what if on top of that, you worked 1 more year? That sounded a little bit more palatable than working 2 more years for her. So as we did that, and we showed the illustration of cutting expenses and also working 1 more year, then we could start to see the pretty dramatic impact that had. We could start to see, Becky, you're getting to that point where we'd feel a lot more confident saying, yes, this is probably much more doable than we would if you wanted to be done today and not cut expenses at all. Now, here's the beautiful thing about financial planning. As we're going through this, there's not one single formula for Becky's success. The reality is it's a series of trade-offs. It's a series of explorations of what's possible, what options are in front of you to accomplish a desired outcome. Not always is it going to be a super easy answer. Sometimes you might have to make a difficult decision. Do I want to work longer? Do I want to sacrifice something in retirement I was really hoping to be able to spend money on? Are there other options? Is it downsizing? Is it moving to a different state? Is it doing something different with your portfolio? All of these, though, are considerations. And as you start to understand what impact these different variables has, changing these variables, understanding different options, you can start to get a sense for what's possible. And after you explore multiple options, you can start to understand, you as an individual, which option resonates or aligns most closely with how you want to go about accomplishing your goals. So if you understand those 3 numbers, what your expenses are in retirement, what your income is in retirement, and what your portfolio value needs to look like, you can start to work backwards into finding the plan that works best for you. Now, one thing I showed in this particular plan is I showed a fairly straightforward example. Consistent income, consistent expenses. The reality is for most people in retirement, income and expenses are going to vary. The income you have day 1 of retirement might look different than the income you have 10, 15, 20 years into retirement. The expenses you have day 1 of retirement might look very different than expenses in year 10 or 15 or 20. So how do you illustrate that? Well, I made this video right here where I walk through another case study showing you what should you be doing if your income and expenses are varying, because that's going to lead to different amounts needed to be pulled from your portfolio each year, and how should you account for that or plan for that. In the video I linked to above, I'll show you just how I do that, so check that out so you can get a bit more realistic of an example of what retirement planning actually looks like. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.